Okay, everyone, welcome. So good to see you here at the University of San Diego virtually. This is Pitch Prep, and we are getting you ready for the San Diego Angel Conference or any other investor meeting that you might be having in the next year. We've got a really good evening planned for you. We have not one, but two representatives of Pillsbury, legal experts, and we have Maisha Cobb, one of the leading experts in San Diego on building teams. So my name is Benton Moore. I'm the director of the Brink, the innovation hub here at USD. We are an SBDC, and those are two of the faces you're going to see tonight. So we have an amazing ecosystem, as you know, in San Diego, and I'm glad that you're here and part of it. Too many logos on small screens. Are you sure you monitoring the waiting room?
Did you
Are
did
you?
you make me the host? I can't really see.
Yes, you are.
Okay, thank you. I'll monitor it.
Okay, cool, cool. So we're really lucky to be surrounded by the most collaborative startup ecosystem in America, in my opinion. Has been for a while, but the word is getting out. People are moving here. So thanks to all of our partners. I'm still getting all the pop-ups.
Anton, I don't think I have the ability to let anyone in.
Okay. Should be able to now. I made you the co-host. Or
Okay.
Stephen, if Stephen is back. So as you know, we have lots of great universities, lots of great startup partners, lots of great investment companies in San Diego. We're all part of a lot of them. So thanks to you all. We are a grant funded organization, which is pretty cool because we get funds from the government of Sacramento and DC when they're not fighting, all to advance entrepreneurship and innovation. We're one of 13 innovation hubs in the state of California, which is a special designation, meaning we can work with high tech and innovative founders like yourselves. So, um, in our collaborative innovation ecosystem, there are a lot of players. This is from Startup San Diego, probably a little dated, but these are just some of the organizations that you can lean on and really find great partners to work with. As you can see, the Brink is strategically located right next to the Angel Conference. It's kind of the path forward that we've built. So, a great way to join the ecosystem and build your startup right here in San Diego. We are, case in point, quite collaborative. The San Diego Angel Conference was started at University of San Diego in 2019. We've since partnered with San Diego State, that's actually running the event. So now we work with the entrepreneurs on the first part of it, and then San Diego State works with the investors, and then we pass the baton to SDSU and Kathy Pucher, our friends, on March 5th. So the Brink is an innovation hub. We accelerate innovation. We only work with companies that are high tech, deep tech, companies that are trying to solve the world's biggest problems. And we have a great, small but mighty team. Only four of us in the production staff. Stephen, Ava, and Pratyusha are all here. And our advising team is truly amazing. We have 20
Ooh.
startup ninjas. Yes, hello, Jonathan. You're in there. And yeah, imagine if you're a
Sure.
solopreneur and you're building a biotech or clean tech company and you go to your team slide and it's you and you can grab three or four or five of these advisors and put them on your team slide. Maisha's just going to talk to you about that. But really talented, deep bench that we have, startup ninjas. So, like I said, we're one of 13 innovation hubs. Our economic impact is over $1 billion, and we are the number one ranked business accelerator in San Diego by the San Diego Business Journal. We have some sister organizations. Most of you know Connect. They are our sister organization and also work with venture capital and
Yeah, that's
innovation.
great. Dale, can I just make one suggestion?
Thanks, Joe. Uh, Zoom. It's you'd think like after all these years we'd have it down, but it's still the Wild West. So the San Diego Angel Conference, most importantly, is the largest one-day angel event, the largest checks written in America, usually between 500 and $750,000. No idea how big it will be this year, but we always guarantee that the winner will receive at least $200,000. So it's pretty cool because as an entrepreneur, as a founder, I've sat in those shoes. You can spend a lot of time with investors and never get anywhere. There's only one winner that gets the big check, but usually we fund between 3 and 5 companies. But you know for sure on May 29th that at least one of those companies is going to get at least $200,000. So it's time boxed, and you're dealing with investors who are very keen on early stage companies. So it's a very special place. We try and work with you as entrepreneurs for seven episodes to try and get your pitch deck looking like the kind of deck that gets funded, and to work with you on your pitch to make sure that you're presenting yourself in the way that works. And then in a few weeks' time, we'll turn it all over to the investor side of the house and San Diego State. So you don't need to come to all of the events to apply to SDAC. And you can come and to the Brink Pitch Prep and not apply to SDAC. This is great training for any entrepreneur and great information for anyone, and a lot of investors here too. And you can attend as many sessions as you like. So ad hoc. It's not use it or lose it. We do a lot at the Brink. We are programming. We had 151 events last year. We do all kinds of crazy stuff. We're running an SBIR writing group right now. We have the Lean Essential Sprint coming up. We have legal office hours, thanks to Pillsbury. And we just finished giving out $250,000 of non-dilutive funding at the ACE pitch competition. So if you have not registered as a Brink client, it's very easy to do so, especially on Zoom, because you can put your phone up and do that. I think most of you are Brink clients. You can register. It is 100% free always and 100% confidential. So very special resource for early stage founders. You can follow us on LinkedIn as always. I'll get moving. So that is that. Okay, let's see. So I'm going to turn it over to our friends from Pillsbury. Really stoked tonight to have not one, but two legal experts. So I'll turn it over to our good friends, Kit Ryan and Kevin Smoker.
All right. Thanks, Benton.
I can
Really
see your
excited to be
slides.
here. Okay, cool. Can everybody hear me?
Sounds good. All yours.
All right. Cool. So first of all, we're really excited to be here. My name is Kit Ryan, and with me today is Kevin Smoker. We both work for a major law firm called Pillsbury. Not to be confused with the Doughboy. Pillsbury is a global law firm with a large reach, and it covers all sorts of different practice areas. But the main thing that Kevin and I focus on are advising startups from early stage through growth to IPO. Our main specialty is in venture capital financing. So we advise lots of startups. I end up being basically an outside counsel that advises them across various different issues, including raising capital. And today we're going to talk about the ask slide, which from my perspective is honestly the most important part of your pitch deck. Kevin, why don't you give a little introduction for yourself? Kevin, did we lose you?
No, but Ben said, you'd think after all this time we'd figure out Zoom, and here I am laughing at that and then on mute as I'm trying to talk. But I was gonna say it's fitting that Ben shared the element of like we start here at USD, and then kind of there's the connection with San Diego State. So between Kit and I, we actually have degrees from both of those places. So this is very, very much foundational for us, and I think what Kid just shared is like so much of what we do is this early stage side of it. And there's a lot of this, which we're going to hit tonight, which is you can go really, really deep in this topic. This is one of those, like, we're going to do an overview, but this is, we can geek out on it and we're so excited to share it. But with that, this is one of those, like, let's get into the intro of it. And, we're domain experts in this. We live and breathe this every single day. So excited to share some of that with each of you.
The last thing I'll just plug really quick because Benton mentioned it before. If you're interested in talking with us about any issues, including on the financing side, you can come to the legal office hours at the Brink host, which are run by Kevin and I. All right, Kevin, let's get started.
Yeah. So, and when we think about like the ask slide, we want to start with like going all the way back to the beginning of what's an ask. And the funny part, when I think about this is we've been doing this our whole lives. We do it every single day. I've got two tiny little Groms, and they're very good at asking for ice cream, like this little girl is. And that, like, keep that in mind that in ask, and when we think about like the ask slide, you've already asked something, right? Like Kit pointed out earlier today when we were talking about this is you are asking them to listen to your deck or look at your deck. So, like we get used to asking things, but when we ask things, there's a difference between a really simple ask and a complex ask. And so a simple ask is just that. It's one step, very minimal friction, easy resolution. Fitting that I couldn't even unmute myself on a Zoom call, but like a simple ask is, can you unmute my mic so I can ask a question? Can I have an ice cream? A complex ask is you're going to have a series of steps before you get to the final answer from somebody. So thinking about it, relationships and raising money are very, very similar, but will you go on a date with me and will you give me money? Those are complex acts that will take time. And then asking for money is a complex ask. And so being crisp and clear about it. And, the pitch being, it's the start of that process. And with
just something to add on top of that is, this is really a full length process, right? It doesn't start with your pitch deck. It doesn't end with your pitch deck. And so you should think of your pitch as a life cycle. And it's likely going to take you 6 to 12, maybe even 18 months to court an investor to eventually commit and you've built enough trust and confidence, which we'll talk about later, in order to convince them to invest in you. And so just thinking about this as, all right, this is maybe the starting point, but it's going to require follow-up. You're going to want to have cold calls. You're going to want to get lunch with them, coffee, and continue that ask because it's all about the touch points and the repetition. And the investor, or excuse me, the founder clients that we have that are successful are the ones who are able to leverage and flex that kind of sales skill that everybody has, but it only gets better when you develop it. And so getting used to asking, getting used to being in front of people is really important. And it's really about the touch points and repetition.
And with those touch points and repetition, right, is that anything in a complex ask, it's not going to get you all the way there on that first step. But it can ruin for a future opportunity. So, if you think about this, like I'm not gonna unmute everybody and say what can go wrong with asking, will you go on a date with me? The answer is there's a whole heck of a lot of different things, but probably one of the most critical is like if you aren't their type or you didn't communicate with them in a way that makes sense in their language or that's appealing to them, investor, that relationship is a very similar one, and maybe they aren't your type. Maybe they're not your type of person or investor, but they might have a friend. So ask for that intro and then saying no. And this like process of just going, hey, they weren't right for me. I've got to move on. It's applicable within relationships and dating. It's also extraordinarily applicable within fundraising and going like, if they're not the right person, you don't meet with them again. Like making sure and you don't burn bridges because things can go, it's very, very small world. But they're asking for an intro and then just saying like they probably aren't for me.
Yeah, and also, thinking about the founders and entrepreneurs that I know who have become successful, they were able to pivot or modify their pitch and the way that they ask and communicate with investors once they've received constructive criticism or once they've failed a bunch of times. I mean, we all know the typical saying where entrepreneurs fail all the time and then eventually they get they eventually win out after failing, hundreds of times. It's true also with a subset like just making an ask and asking investors to invest in them. And so just being able to modify your pitch deck, reconstruct things after you get feedback from people is a really important skill too. And it's just like how you would modify how you ask someone on a date if it doesn't go well the first few times.
Yeah. And with that, right, it's then figuring out who your target demographic is. And so, kid, if you want to hit, like before you even craft that ask, like what do you end up doing?
Yeah, so what we like to think about first when we're thinking about the ask slide specifically and what kind of ask you're going to be making is to take a step back and say, what do you even need before putting together your ask? And since we're doing this for a pitch deck, it's going to be money, right? And so how much money do you need? Because that's going to influence who you're going to be asking. For example, on the slide here, we have three kind of different buckets, and this is probably applicable to most of the folks on this call. If you're under $1 million, that kind of category, and maybe we switch to the next slide, Kevin, to talk about this. So these are kind of our categories. And just to preface, we don't think that these are end all be all. Like, for example, we have in the $1 to $5 million category, we have friends and family, angel, and then that's going to happen within 6 to 18 months. For us, sometimes we have clients where we incorporate the company and then the next day they get a $5 million check. It's different for everybody, but just generically, if you're raising less than $1 million, your typical audience is probably going to be friends and family and angel investors and maybe family offices as well. That's kind of your audience. And so that's the thing that's in the back of your mind when you're crafting, like, what is exactly am I going to put into my pitch deck and what exactly am I going to put on my slide? The next thing here is about the vehicle. So you've got, if it's under $1 million, that's typically going to be your safe or convertible note. And we will talk in detail about that later on. And then the last thing we just want to talk about is your typical life cycle, right? So that's probably going to happen within the first, 6 months from the day you start your business, typically. The next category here, we've got the $1 to $5 million range. There, we might be talking to venture capitalists, some more sophisticated investors. And so, you might tailor your ask or your ask slide so that it has more deliverables as the things that you're providing as a result of the dollars that you receive in. Whereas if you're doing the angel investor group, you might be doing product development as two kind of differentiating factors. There, even at the $1 to $5 million range, I would argue you're still in the safe convertible note land, but you're kind of on the upper end. So you're less likely to be doing that at the $5 million side, but you're still kind of at the cusp. And that's generally going to happen between 6 months to 18 months after you've started your business. If you're on the standard, founder track, the last one is kind of 5 million plus. So here we're talking about institutional financing. So if you're going to actually issue preferred stock, you're raising a priced round, that's kind of the same thing. And that's typically going to happen within, after 18 months. Series A financing, if you've heard that terminology, that's all within the same bucket.
Hey, Kit, while we're on this topic, family offices have been increasingly important and active. Would you say they are slower or faster than some of the other groups in the categories, like angels?
Slower in terms of like diligence, delivering money. What do you mean
From
exactly?
first meeting to making an investment decision.
Oh, I would say they're slower. I
Okay.
think that it's a little less common, and so they tend to not have as much experience, I would say. Not to say that it's anything bad going with a family office. I think that's totally fine. Um, but like a very sophisticated angel group, at least the few that I'm a part of, I mean, you can get in meeting to funding within less than 4 weeks, like 3 weeks. It's sometimes even 2 weeks. That's on the rarer side because they can just go burn through due diligence and they know exactly what they're looking for. Now on the venture capital side, that process can take you several months.
Okay, thanks.
And on the lower end of that, this is like the first time we're putting up the friends and family, so always an earmark. And Ben, you may hit this several times, but just to acknowledge that if you're going to do anything with friends and family, you want only accredited investors. If that term is new to you, please use Google. It's a really simple view. And I flag this because typically like 25K is about the easy line to say if somebody can write a check for 25 grand, typically they're not going to be as noisy, and as problematic on your cap table. And part of that is not all money is like equally as vocal, right? And you don't want money from your Uncle Eddie, who's then for $1,000, who then every 2 days is asking you a question about the business. So just being clean about, like what style person you're fundraising from, and what you might say yes to.
Yeah, that's a great point.
Yeah, you can definitely ruin a Thanksgiving that way.
Absolutely.
Okay, we're gonna talk about what you actually are asking for on the ask slide, because that's what we're really here to talk about. And what you're asking for is trust and confidence. And that's really what you're trying to build throughout your entire pitch and really throughout your entire relationship with your investor. Because if they trust you, I mean, they're trusting you with their money. And so that's extremely important. So you need to build that trust so that they know that you're going to do what you say you're going to do with the money. And then confidence. A lot of the times when I watch entrepreneurs pitch, 99% of the time, they are more sophisticated in their technology and their industry than I am. And at least at the onset, I'm not going to do the due diligence to know whether what they're saying is true or not. And so I have to trust what they're saying is accurate during the pitch, and then I have to have confidence that they're going to implement the things that they say they're going to do with the money that I'm going to provide them. And so that's what you're trying to build throughout your entire pitch deck. And that's what you're trying to communicate at that last kind of nail in the coffin, maybe not the best analogy, but that's what you're trying to communicate at the ask slide. And so that's why it's so important, why I think it's such an important slide, and maybe the most important slide, because you can kill a pitch by having a bad ask slide, and you can destroy trust and confidence if, for example, you have a crazy out there valuation that's not justified. Even though you provided a fantastic pitch before, you were able to justify numbers or show evidence of what you've done in traction. If at the end you throw up a $50 million valuation cap, you're definitely going to destroy trust and confidence. Okay, so now the way we think about what a great ask slide has is really 3 buckets. How much money you need, what the terms are of that money, and what will that money get you. And each one of those buckets have subcategories, which I think.
And before we hit those subcategories, we're gonna also hit this first part, is that you can confidently tell an investor that. One of the most painful things to watch in any of the pitches, public or just private, it's one-to-one, is a founder and a team that know every step of their marketplace. They know the problem, they know the solution that they're pitching, they know their tech stack, they know their team, and their team is amazing. And they get all the way through that, and then they get to a part that they might not be as confident about, that they're a little bit nervous about. And they say, and we're raising $1 million. It's going to help us hire some engineers. And you're like, whoa, 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 what just happened here? And so that confidence of, that power pose to before you get up there and ask for money is like that. Say back to you're instilling, you want to earn their trust and confidence of an investor, that you can confidently walk up and say, this is what we're going to do. And if you can launch through those 3 things confidently, it gets you to a much different place than meekly ending your presentation.
Yeah, and with that confidence comes the ability to articulate why you need that much money, right? The total funds, how much money you actually need and why, and what that timeline is going to look like. If I fund you today, what are you going to achieve over the next 6 months, 8 months, 12 months, and get you to your next either sale of your company, but more likely your next round of funding. So that's why you got to think timeline and also total funds. We're going to go into I think the next slide when we talk about kind of how we think about total funds. But for the next bucket here, the terms of that money, you're going to need to be able to confidently tell them what instrument that you're going to raise on, the terms of that instrument, which are really broken down to valuation and valuation cap. And we'll talk about that. But one of the reasons why it's so difficult to become an entrepreneur is because you have to be an expert in all of these different fields, right? Or at least be able to appear as an expert. And you can leverage other resources like your advisors to help you, speak intelligently and know what you're saying. But that's why it's so difficult. And then the last one here is what that money will get you. What are you going to be using for that money? And what are the pain points that you have? What are the things that are blocking you from getting to your success? It's not just money, right? There's an underlying issue that money solves, or probably more likely issues. And being able to articulate and point to those issues and say, okay, this money solves these problems because of X, Y, and Z, and then I'm going to get to Q or whatever. That's what you want to communicate on your ask slide. Okay, now this is actually the kind of 5 categories that we're saying actually need to be on your ask slide. Total funds, we talked about that, the amount that you're raising, timeline, what that gets you in terms of how long you're going to be able to use that funds, effectively your runway, the uses, what are you going to use that money for, the terms of the investment, so valuation cap, discount rate, and the actual valuation of what your business is if you're going to do a price round. Okay, so this is what I was alluding to earlier. And there's a lot of words here, but basically what we're trying to communicate is when you're thinking about the total amount of funds that you're going to raise, you should have planned this out. You should have put a budget together and a business plan for the last 5 years or for the next 5 years. And what we like to encourage our clients to do is pick a date that's like 5 years in the future and work your way back from some sort of accomplishment at year 5, like you're selling your business. At that point, if you're selling for a certain, multiple, let's say like it's 100x EBITDA or something like that, then figure out what it is you need to achieve between now and then to get to that level of EBITDA. If it's like a certain amount of customers, target that amount and then figure out, okay, how much money do I need to have in the bank account to put to marketing, to put to R&D, to all of these things, like assuming everything goes right. So just perfect scenario, work your way back all the way to today. And then once you've calculated how much money that you're planning on raising, after accomplishing all that, just double it. Just double the amount that you think that you're going to need. And then that's the amount that we suggest that you say that you want to raise. And you have to be able to articulate and show that. And once you've done that exercise, you should be able to articulate and explain that to the investor who you're trying to build that confidence and trust with.
The key detail in all this that, Kit, with what we're talking about both in terms of funds and the timeline is like just what is the next inflection point that you're going to hit or inflection points and what's that going to cost. But then also just how long is that going to take? And we jokingly like, and then double it because things go wrong, right? Like just there are challenges in this. And then you say, well, what things are there? What uses are there? It can be people, it can be technology. If you're in any of the hard sciences, it can be testing, it can just be pure marketing. It's like, Kid alluded to what money is going to solve this, but what are you actually going to put it towards? It can be anything that's going to help you grow the business. You just have to have a clear, crisp ability to say we need it to hire 2 engineers. Like that's what I need them to do. One front end, one back end. Great. Like that's what they're going to build. And so like that, it's the uses can be pretty varied, but you want to have a clear part of that. It flows into your timeline and your overall plan and strategy to move forward of like, what am I going to do with this money and what does it help accelerate?
The other thing too about raising more money than you think you need by, essentially doubling it, it's hard to plan. It's hard to budget. Things go wrong, like Kevin said, and it's definitely more difficult to raise in a down round than it is to have an accretive round. That's just for sure. And so you might as well raise more at once, because once you've built momentum with an investor base, more people tend to pile on. It's easier to generate cash flow from investors when other people are investing at that period of time. And it's more difficult to go back after the fact with your tail between your legs and say, oh, actually, I need some more money. And now we're going to talk about the terms. So we talked about how much money you want to raise for the funds aspect. Now we're talking about terms. What really this comes down to is your financial instrument. So the type of security that you're going to raise the cash on, and then your valuation. And I think our next speaker is specifically going to talk about valuation. So we're not really going to touch on it, but what we will touch on are the financial instruments specifically. So I like to think about this in kind of two buckets. I know we have three things here, but really it's two buckets. You have your convertible securities. Those are your safes and your convertible notes. And then you have your preferred stock, your equity securities. That's what your price round is. Now, the safes and the convertible notes, I think for most of the people on this call, are going to be your best bet. It's convertible. You're arguably not having to negotiate over a valuation at this time. And the best part about it is it sits on your balance sheet and it just waits there. They call it ghost safes or ghost convertible notes. They sit there, or excuse me, at least for the safes, they sit on their balance sheet. And that, as opposed to your preferred stock, which you're actually issuing equity, there's rights and preferences that are provided to those that receive that equity. And yeah, we can go from there. Melissa just sent a message that said, I thought that investors don't like safes. I would say technically, convertible notes are more investor friendly than safes. The reason for that, and we're gonna go to that in a couple slides, is that convertible notes have an interest rate. But I will say the market has completely shifted in the last like 12, 18, maybe 24 months. Almost all of the pre-seed deals we do are on safes. Every angel group that I'm a part of, they force you to do a post-money safe. They will not do the convertible notes. Now, that's not true across the entire US. I think that's more common on the West Coast now than on the East Coast. I think the East Coast people are still using convertible notes more often than safes. But if you look at the market data, especially from like Carta, almost every one of the pre-seed rounds now is safes. We got another question here. I think it was, is there a downside to punting on valuation? Oh, are there any drawbacks of putting valuation on your slide? I would argue that there is a drawback of putting that. The drawback is if you put too high of a valuation, you can turn investors off. I can't tell you how many slide decks I've seen where I absolutely loved the investor. I loved the pitch. And then you get to the terms and they threw in like a $50 million valuation cap. And it turns me off. Not everybody's like this, but it turns me off so much. I almost don't even want to talk to them because it shows a level of lack of sophistication, I think, that makes me not want to make that investment. Unless they have some really amazing justification for it, I would recommend if that's what you're going to go with, as opposed to not putting a valuation, I would not put it. But if you think about negotiating strategy, I think that most of the books these days tell you that you should make try to set the valuation. So you set the peg first rather than waiting for somebody to say something to you. And that's why I would argue that you want to put a valuation on your pitch deck, but it should be reasonable. Anything there from you, Kevin?
Just it's have a strategy and a backup to it. If
Yeah.
you're going to put a number out there, you want to be very thoughtful about it. You want to be on market and you want to be clear about it. And if you feel very strongly about those, great, that's fine. But if you're saying, hey, I was told I had to put a valuation on it and you're not quite sure, that's where it gets into really dangerous territory. I always come back to the trust and confidence thing, which is that if you have absolute confidence behind that number and feel very good about it, great. That's like all of these, right? Which is like, I believe deeply that it should be way outside the normal bounds. have some really good logic to it. Know that you're gonna make some people kind of get squishy faced and go, "Oh, what are you talking about?" But if you have great logic and back up to it and a real strategy, that can behoove you.
One clarification point I want to make is it's easy to get confused when we talk about valuation versus valuation caps. Now, I'm kind of using those almost interchangeably in this conversation. I want to just make sure that I clarify the two because you're technically not setting a valuation for your company when you put the terms of your safe or your convertible note have a valuation cap of X. You are setting a valuation if you're going to raise a priced equity round and you tell the investor that you want to do a pre-money of X. Those are two different concepts, and I just want to make sure that that's clear. For most of you, you're probably going to be in the safe and convertible note land, and so you're talking in valuation caps and not general valuation.
So
Okay,
while
Kevin.
while we're here, Kit and Kevin, what percentage of seed stage deals would you say are priced equity rounds?
I don't have that statistic off the top of my head because I think that people say seed and they really mean pre-seed. And in my mind, pre-seed is where you're not issuing preferred stock. Your seed round is where you're issuing preferred stock, but you're providing investors with bridge rights and preferences. So they might not receive, for example, the right to designate a board member. Then when you get to your Series A, then they get all of the typical rights and preferences, including like right to designate a board member. Your pre-seed, however, that's where you're doing the safes and convertible notes.
Cool, thanks.
Okay.
I'm gonna
I know
bounce.
we're getting quite a few questions in the chat. I'll try to touch on them as we go because we are going to talk about some of these different things like the valuation cap and discount rates. But I just want to be also cognizant of time and leave room for questions at the end.
I think we hit a lot of that. Maybe we'll head right into an overview of safes. So try and do this quickly, but also be a little bit helpful here. Is that at this point, 80 to 90% of pre-seeds are in that safe category. If you're looking to do a safe, it's been developed by Y Combinator, get their agreement there. If you start making any modifications to it, you're now getting into a agreement for future equity, not a simple agreement. So, any changes, you're going to get people like Kit and I engaged. They're designed, we're going to hit a lot of this in a second here, so I'm actually going to bypass it and just say that, a lot at this point, it's the promise. Like that's what you're doing, and it can be very, very fast.
Yeah, I want to stress one point that Kevin had said there is the whole point of the safe is to be simple and quick and effective, right? And to avoid negotiation and legal fees, to be honest. But what happens inevitably is sophisticated angels or sophisticated VCs that enter into these safes, they modify them to their benefit and to your detriment as an entrepreneur. And so if that happens, you really should be reviewing it with counsel. It's really important. A great example of this is a lot of incubators. They will throw in a term called an MFN, a most favored nation provision, which effectively says, if you give anybody else a better deal in the future, I also get that deal. And that can be extremely dilutive to the founders, unfortunately. And so just being aware of that, knowing that people shouldn't be modifying these things and tossing in different terms. And also that 80 to 90% of pre-seed rounds are safes. That is a statistic we pulled from Carta. That's not just something we're throwing around.
Yeah. In the interest of time, we're going to skip over that one. And Kit, if you want to just hit some of the key terms here.
Yeah, let's talk about this really quick. So there's really there's a couple of different types of safes, but you can kind of think of them in various buckets. I'll start with there used to be something called a pre-money safe. A pre-money safe basically means that all of the safe holders will dilute themselves when they convert into the future. And just maybe stepping back, A safe itself is a promise or it's a right to convert into equity when there is a future financing where preferred stock is issued. In that future financing, the safe will then convert from being a piece of paper into that actual preferred stock that's issued in that financing. The benefit of the safe, though, is that they typically have these mechanisms that allow them to convert into more preferred stock than the dollars that they invested would allow them to receive if they purchase directly in that preferred round. Now, what that just means is they will convert based off either a valuation cap or a discount rate. A discount rate is kind of the simplest way to think about it, because if you have a scenario where in your preferred round, you have a company, it's priced at $10 million and there are 10 million shares outstanding. That means the new preferred stockholder will purchase at a rate of $1 per share. If the safe holder has a 20% discount rate safe, then they will convert at 80 cents per share. And so if they invested originally at $100,000, they will get 125,000 shares, as opposed to a new money investor who, if they invested $100,000, they would only get 100,000 shares. So you're giving somebody a better deal for taking on additional risk of investing in your company earlier on. The same mechanism works with the valuation cap. The way that would work in our example, if you gave somebody a valuation cap of 5 million, you have a round where it's $10 million pre, they would convert based off $5 million. And that's why we've been talking about valuation cap versus valuation, because they are kind of different, even though we're sort of talking about something that's very similar. And I know that can be kind of complicated. So happy to feed questions at the end, or you can always come talk to us during the office hours as well. All right, Kevin, let's move on.
Yeah, I'm gonna just hit convertible notes to say, again, it's a very minimal amount of the market at this point. So we're gonna say they're in the slides, but we're not gonna speak to it in the interest of making sure we leave even more time for questions.
Yeah, Nick just put a question that I want to touch on really quick. He said to remind people that investors are going to ask you why you choose your cap. And that's really the point that I've been trying to beat like a dead horse, because it's really important that when you put that on your slide, that you want a $5 million, $6 million, $10 million cap. It's like, how did you get there? And I think other people have been asking, how do you value your company? And I think our next speaker is going to talk into that in detail. There are different mechanisms. You look at comparables. What is the market going for SaaS companies that have, $100,000 in ARR, things like that, or you do a DCF analysis. There's different mechanisms, but a lot of it is term sheet negotiation. That's the best way to pick a valuation. What are people willing to invest in your company at today? If you have multiple term sheets, you can have a better valuation. And here we are setting a valuation.
And purposefully, we've got, the art and Kit hit some of the science pieces. We'd say particularly very early stage. It's art. There's an art to this, and this is also part of I'm going to call it negotiation and sales process. It's finding out what others are doing and having a perspective. I think Nick highlighted it beautifully. It's like why you're going to choose what it is that you're going to say. And that's where it's understanding. It's attending things like this. It's knowing the market and what other people are doing. And to that, knowing the market. We mentioned Peter Walker, or we mentioned Carta here. If you're not familiar with Carta, not a big deal at all. But I would absolutely encourage everybody here to follow Peter Walker on I was going to say Instagram, on LinkedIn. But he's a prolific insights sharer there on a daily basis. And to get, a lot of the data that we've shared it breaks down actually by market, by geography. And it's well worth it. It's also, You heard a lot about the name Pillsbury during all of this. Is that like, look, we're also domain experts in this, and like getting an evaluation, getting a perspective from people that are living and breathing this on a daily basis. Ask for insights. Ask your mentors. There was a great slide that Benton shared earlier about like mentors or people who are fundraising or have or see a lot of pitches and understand where things are at. That's like just high value in terms of doing that to get a sense of it. And this is, I'm going to say, this is Kit's favorite slide. So we're going to pause here for a second because so much for me about this is like, look, you can do a great job, and then you get all the way to the end, and it's kind of like your final, like, okay, now we're going to get to the next stage, and it's that like what can break trust and confidence when you're presenting and when you're getting into the pitch slide.
Yeah, I love this slide because I hate when I watch a pitch, it's awesome, and then we get to the ask slide and they have no idea why they picked $1 million for the amount that they're raising. They have no idea why they want a $30 million valuation cap, even other than they don't want to be diluted. It's just having a plan and an explanation of why you picked these things that makes logical sense. And a lot of that is just the background work into figuring out, okay, how much money do I really need? What what does my company look like from a valuation perspective? Why do I need this money? Like, what exactly am I going to do with it? Having a plan. That's why it's all about the trust and confidence. You build trust and confidence with investors by having a plan. And that's why I'm passionate about this slide.
And with that, some of the things you can absolutely screw up on, just the valuation that Kit said, but also not having the ask slide altogether. Sometimes people go through these, and you won't because you've been through this, but also just because of the nature of the program. But I've seen pitches in public domains where like it was like, and that's it. You're like, ah, what are you doing here then, right? And it's like, okay, we did it for publicity or we did it for practice. But and then consider your audience when you're doing it. Like absolutely consider your audience, so like who you're speaking to right now, and that making sure, right? I just reviewed a deck where it was incredibly specific, filled with detailed jargon, where I was like, I don't know this market. So as a generalized investor, like I not quite sure what you're hitting. So be thoughtful about that. So we're gonna go a few more minutes on just looking at some example pitches and breaking them down and speaking to those, and then we'll keep trying to hit questions in the chat.
Okay, so obviously this is a really bare bones example. The first thing just to mention, we've got 1.5 million. This is for engineers and marketing. So I guess there is kind of a uses. With this money, we'll hit all the milestones for our next 2 days. Timeline, but it's a bad timeline. And then they say thanks. So they're really missing the terms. They're missing the financial instrument. They're missing really an effective uses of cash. So all around, just bad example. This one I actually like. So we've got $1 million for a safe note, just kind of a technical thing. There's no such thing as a safe note. It's just a safe or a note. But that's something that only lawyers like me care about. We don't see any valuation cap or discount rate, so it's not clear to me what they're trying to say there. From my perspective, I think that they should include something like that. At least put a discount rate of 20%. Or whatever it is percent that you're going to provide. I like that they have the targets, team, product, revenue. I would prefer to see something like percentages, right? So if it says like 20% of that million is going to go to new hires, 30% R&D, et cetera, et cetera. The other thing that I think this is kind of missing, even though I like this slide a lot, is what are the pain points, right? I think the best slides show what exactly is failing right now that the money that you're going to give them solves. What about you, Kevin?
So, and this is where, or Kit and I were looking at this. This is interesting, right? Because I love this simplicity. And so there's an element of this, right? Which is you can talk to two people, even Kit and I work together a lot, that just view it a slightly different way. And so there's a piece of this that is like style and substance that you can absolutely just have a different style to it, right? And then, I like the simplicity of two AEs and two engineers. Like, okay, kind of extrapolate how much those are going to cost. But I want to know what that's going to get us, right? And how much of that is immediately we need it and how much is it building the pipeline for our future product development. And so, like that's again leaning of like where our lenses are. I do think it's also, as Kit mentioned, it's like he notices right away, safe note. This is a great thing for me of like, I notice right away the fact that there's not you don't close the two AEs and two engineers. And so just this small typo, depending on who you are, like those are just indicators of attention to detail. So, it's high value when it's like, if you're doing this pitch and you've got time to do it, it's making sure that you've got no typos that are going to just send somebody that just viscerally goes, how did you miss that, right? Because it's small indicators. So, but again, this is like there's no perfect way to do this.
Yeah, I love that Benton just pointed out in the chat the missing parentheses.
Yeah.
Look, you just killed trust and confidence. I can't trust you to be accurate and have a strong attention to detail. Why am I going to trust you with my money? Okay, I like this slide too, but it's a lot to take in. Here we're saying, okay, we're raising $2 million to execute on 3 objectives. All right, we have the amount of money that they're raising. I like that. What are the 3 objectives? Okay, we've got these roadblocks. Okay, they talk about the things that are going wrong, and then they talk about the things that they're going to achieve with the dollars that they're receiving. I like all of that, right? Execute on GTM via webinars by end of year. So we've got a timeline there. Hire researchers and engineers to build plus train rounds, S1, super interview, AI agent. That's relevant with the rest of the slide deck, but I like all of that. I like the taking what the problem is. This is what we're going to use with the money. The thing that I would like better about this is, okay, how much is going to go to each of these things? And what is this going to really transform from an ROI perspective? And also it's missing the terms of the investment. So I think all of those things could be items that are improved upon.
And a flag here is that Ben just kind of hit it a little bit is remember that speaking to your audience, if you're going to use an acronym, a 3-letter any acronym, right? That make sure that it's one that your audience knows well enough, right? And that GTM, okay, go to market. A lot of people know that. That's somewhat ubiquitous. But if you're going to go use industry jargon, be very careful about that unless you're planning to only speak to investors that are deeply engaged in consumer packaged goods. You're like, okay, great. Like I'm only talking to them. No problem that I'm going to get really nuanced on it. But if you're speaking to a general audience, particularly one like the SDAC group, be careful because this industry so well, they may not. And if it's just filled with a lot of TLAs, so it's 3-letter acronyms, you get people's eyes glaze over real quick because they're like, I don't really know what that means, but I guess it sounds good. Making sure that you're speaking the language of the person that you're communicating with.
Yeah, especially if your audience is, in that kind of first 2 buckets, right? So your angel investors, and your friends and family, and kind of like your family offices to some extent. You really want to just get them to understand what it is that you're doing and why you are going to be successful in it. Don't try to make them think that you're the smartest person in the room because you know all of these technical things. That's kind of to the same point. Yeah. I think we could probably skip this one and go straight to questions.
Yeah. So before we get questions, I wanna hit an element of this, which is that this is going to be part of your journey, and that presenting and then getting to the point where you close on your ask slide is that your style and your substance and who you are during that part of the process, you're going to be that. It's a little bit like going on a first date with somebody and then thinking, okay, we're going to get married. And it's like, if that's not who you are, remember that's who they're expecting the whole time. And it's going to be a long journey of multiple years, 7, 8, 9, 10 years with an investor like this. So don't forget to have some fun. This can be part of the fun, and it's part of the journey. It's part of the process. And with that, we'll hit questions, and maybe we'll start, John, with what's a family office. Kit, you want to take that?
Yeah, it's basically just like a investment firm that focuses on high net worth families, and it pulls money together from those high net worth families and it manages it for them. The slides, I believe, Benton, will be provided. We sent them
Yes.
over to you.
Yes.
Okay.
If you're comfortable sharing them, we will definitely make them available. SDAC, I'll let you know, SDAC does not decide what the terms are. The entrepreneur, the founder does. That's why we're doing this Ask Slide training, because you're going to come and present what you think is the best. SDAC has invested in a lot of convertible notes, a few priced rounds, and quite a few safes in the last 2 years.
Our office hours, we provide them monthly, sometimes bi-weekly. It depends on the month and our availability. I believe that you need to be a Brink client. And Benton, if you know anything else about how they register for that, can you let them know?
Yes, you do need to be a Brink client, but then we reserve spots. Stephen, if you can throw the link in there, it'd be great. It runs through Natalia Pence, who's our in-house legal specialist. But we'll put the links in there. As soon as you're Brink registered, you'll get access to it all.
Is there a consensus of why there's been this shift for safes in the last 12 to 18 months? I think that Y Combinator came out with this safe. It's similar to the NVCA forms, which are a form of documents that everybody uses essentially for price rounds. And because of that simplicity and consistency, people have just preferred the safe. It's cheaper from a legal perspective, and so it allows you access to capital faster than something like a convertible note. And I think it's because of that simplicity, because of that speed, and because now people have done it for several years, people are getting more comfortable around that instrument. And that's what the shift is all about. I'm trying to read the next question. So concerning fundraising strategy, if you're raising a pre-seed round, how much do you want to mention the next round and when it will occur? I think that you should totally have that planned out. I don't think it's necessarily something you need to put into your slide. You can if it makes sense, especially if it's around like your overall strategy, but you should absolutely have that planned out. You should know I'm raising money today and this is going to get me 12 to 18 months of runway, and I'm going to raise my Series A, and my Series A, I'm going to have achieved this, and I'm going to have this valuation. That's what you need to have in the back of your head. The other part of that question is about stacking safes, and I just want to, this is an important concept. So if you stack post-money safes, you will only be diluting yourself, and that can have a huge ripple effect if you just casually raise money on post-money safes. So it's something to think about. That's definitely something you want to understand from a cap table dilution standpoint.
What about stacking pre-money safes?
Stacking pre-money safes can also be dilutive, but it's not nearly as dilutive as the post-money safe. The reason is that it's called post-money means that it's post everything except for the new round. And that means that only you, the founder, and the rest of your founding team are getting diluted by the safes. They are not diluting each other. They, being the safes, do not dilute each other. The pre-money safe, however, all the safe holders dilute each other when they convert.
There's a question on alternative fundraising, so crowdfunding, and I'm going to say that I just had a great conversation with an entrepreneur, and there's part of a panel around that. Getting creative is and finding ways to make it work is one of the great entrepreneurial skills and capabilities. And so if a crowdfunding for 50 grand or something like that works for you, great. I will acknowledge because I've been part of doing these. They're very time intensive, can be very challenging. But if you only need to like pre-sell a little bit of product to get yourself to that first model of it, awesome. There's certain products that it and businesses it works really well in. But there's many where it's just an incredible time suck. So just kind of be very clear on is crowdfunding for you and your type of company, but finding ways to just make it work is one of the most special sacred entrepreneurial abilities.
It can sometimes disrupt your cap table though, and it's important to have an understanding of the security law implications. And so having a conversation with your attorney about crowdfunding specifically is important. The last question we have here, if our financial instrument is a safe, is there a need to still have a backup valuation number ready for discussion? 100%. Your safe 90 times out of 10 will include a valuation cap, and that you need to have an ability to argue what that valuation cap should be. And that's effectively a valuation discussion. But when we advise our clients, you should be thinking about that valuation as the valuation at the time when you do your financing, because that's when it matters. It doesn't really matter today. And that's the argument that you want to have with your investor about why it should be higher versus the lower valuation that they're inevitably going to give you. Also, it tends to be better for the entrepreneur to fight for a discount rate rather than a valuation cap for many reasons, just how it works out mathematically. But investors tend to push for the cap and inevitably win that argument. So just be prepared for that.
Yeah, and most investors will not touch an uncapped safe note.
Yeah.
All right, this is the last question. I'm going to take this friends and family, non-accredited. What are the negatives?
Yeah, so essentially, there are different security law regulations that say who you can and can't receive money from. 506B allows you to receive money from both accredited and non-accredited investors. And so you can do that, file a Form D and get your coverage and get up to 35 non-accredited investors. However, you have to provide all of those non-accredited investors with additional disclosure, access to financial statements, and a ton of additional work needs to go into satisfying those regulations. And failure to satisfy them can disrupt your entire financing. And that is why it is just much better to be sure that you have accredited investors. And honestly, you shouldn't be taking money. It's almost an ethical thing. You should not be necessarily taking money from people that don't have the money to satisfy being an accredited investor.
Yeah, this is the granny rule. And if you are taking money from friends and family, it can often be the last money that you ever receive for that venture, because most sophisticated angels and all venture capitalists will shy away from investing in the company.
Yeah, that's a great point. They will diligence your company, look into all of the investors that have previously invested in you, and then when they find out grandma is your only investor, they will be turned off. Okay. I think that we got through all of them.
Yeah, good stuff. Thank you, Kit. Thank you, Kevin. That was brilliant.
My pleasure.
Welcome to hang out and learn about Team from this is two of my, we're going through the decks, the slides on a deck, and these are two of the ones I, as an investor, always look at, Team and the Ask slide. And quite often, there are a lot of investors who never get further than that. So I'm glad we have these two today. Great stuff. Reach out to us, become a Brink client. We can connect you with incredible resources, including Pillsbury. So thanks again, Kit. Thanks again, Kevin. And right now we have the great honor of having Professor Investor Maisha Cobb, who teaches at San Diego State, is an advisor with the Brink at USD, an investor with New Fund, and probably 17 other more important gigs we don't even know about. So team guru Maisha Cobb.
Thanks.
Good to see you.
And when we did this after with legal, I was like, oh, how is that a tie? But I was loving everything that Kit and Kevin were talking about, and especially the slide that was Kit's favorite slide about, what are you asking for? And I think it ties so nicely with this idea of your team.
Alexa,
And
set timer for 12 minutes.
oh, Melissa, we need to put you on mute, and good to see you.
12
Um,
minutes.
and so we're going to talk about what investors are actually betting on and why team starts to matter so much for this. Because I love the ending of that where we talked about the valuation, but part of valuation is, are you going to be able to achieve your results? And so can you show and demonstrate that your team is going to be one that can get you there? So mentioning Carta, here are some stats from Carta. There is interesting data that shows in the market now, there are roughly 37% of founders are solo founders, solo entrepreneurs, which is about a 50% increase over the past 6 years in solo founders. But as you can see with this number here, they only get less than 15% of VC investment dollars. And so my question as we kick off, and I like to have all my presentations be quite interactive. So I'm going to ask us to use chat. Given this big gap between the growth in solo founders, but solo founders only getting less than 15% share of dollars, what does that suggest about the presence of a team? What does that suggest? Why does a team matter? What are some thoughts? Love that, Benton. Absolutely better together. Let's build on that. Yes. Srimanas, diversity of thought, de-risking. But back, I would love for you to build on that a little bit. De-risking what? Cancel, yes, yes, yes,
I
yes.
guess
Yeah,
I
go ahead.
guess the combination of founders gives this perspective to the investor that they can cover the weakness of each other. So that's kind of de-risking.
Yeah, yeah. So we don't get too tunnel vision. I love all these comments. So a couple of things that I wrote down that I think a lot of you are bringing up here is A, having a team signals that other people believe in the problem that you have and that that problem is worth solving. I think it also demonstrates that as a founder, you are capable of building a team around you and getting people that have the staying power with you. You can mobilize that talent to help you attack that problem from multiple angles. And then you don't have to solve new problems alone. So I think about a business, especially a startup, as just being a series of problems that we have to confront every day. And the decisions that we make around those problems are really going to help us get to meeting those valuation numbers and delivering to the market and being successful in the market, or not getting there. And so great feedback on why teams matter. So we're gonna in the beginning of this presentation, we're gonna follow a hypothetical team called Nova Pure AI. And so here's the team. We have Maya, who is the founder. She has a PhD in microbiology. She graduated from UCSD. She's a visionary. We have Liam, who is our head of product. He is an engineer. He is also from UCSD. He really cares about sustainability. And then we have Pat, who is our COO, who is our business development operations person. I think he does finance too. He's also from UCSD. And he has a passion for sorry about my typo on here, finding ways to be fiscally conservative is his thing. So the company, they're building a intelligent sanitation system that uses AI to detect pathogens and deploy disinfectant in real time. So Maya has recruited Liam and Pat to join the team. as product development, CFO, COO, and they bring about 16 years of experience in a specific area of microbiology. And now they've secured a meeting with an angel investing firm to pitch their idea. As they prepare, we start to learn a little bit more about the team. So Maya is insisting on answering all the questions. So sometimes before you pitch, you will get questions that come from the investors and things that they may want to know. So she is answering all these questions, even when they're directed at others on the team. Liam, who's our sustainability guy, insists he believes the opportunity is to pivot into biodegradable, eco-friendly products that are not AI powered. And Pat thinks the idea of eco-friendly is interesting, but worries about money since it's not aligned with their current product roadmap, their technical advantage, or their pitch positioning. And we just had a long discussion about how you want to make sure that you get from a safe into a seed round and actually start to convert some of that. And if we are this team, looks like we might have some problems there. So let's get into the pitch meeting and then we'll talk about whether you think they are fundable or not. So the team arrive at the meeting and they are tense and not entirely in sync with each other, as we learned from the previous slide. They're set up with an investor who is Kai, who is tough but fair. And so Kai's first question is, how defensible is your AI platform? To which Maya quickly begins answering, because that's what she does. Our core focus is AI. But Liam interrupts her and says, we're also exploring again a green chemistry line. Later, when asked about equity, Maya says she owns 90%. Liam and Pat have 5% each. So I want to pause here. And the real question that I have for all of you is this a team? Is this a team? Why don't we give some comments in chat? Is this a team? Benton, I love your first things. Yes, a dysfunctional one, more of an employee relationship. 3 individuals, yeah. No need to, they need to row together, yeah. How are the founders of this team an example of paying the rent? I don't understand that question, Tim. Maybe you can build on that a little bit. No one uniform message, Maya owning 90%. Yeah, I would say that that this is a founder who is finding support staff to build on their vision. Oh, I see what you were saying, Tim. Thank you. And so we can see what some of the compensation is, right? And so let's assume that they're getting paid equity, and Maya owns 90%, and the rest of the team have 5% each. So even though we have brought bodies together, they are definitely not acting as a team. So one of the things that we need to be thinking about is when investors are seeing you, they are looking at everything about the way you interact together, about the way your vision is going to hold together, and about how you're going to be able to execute. So what they are actually evaluating are a couple of things that this team isn't demonstrating. So the first is how agile and flexible are you? And so when I think about agility, it's more than just being able to act fast. It's also being able to pivot when the market expects you to pivot. And it's also being able to execute on those key areas that are going to mean your business is going to be successful. And so this team had some challenges in the execution focus. It is also about being balanced. And so there are going to be a whole lot of challenge points that happen on this journey of building a startup and a lot of pivots along the way. And so how resilient is the team? I think the piece that's important here too is accountability. Is this team holding this founder accountable? Are they able to challenge ideas with each other, or are they just following the leader, which it feels like they were doing in this meeting when Maya takes over everything? And then, as many of you have already mentioned, that other piece of balance is all about diversity of thought and being able to have different perspectives that come in to the organization and give and bring in their different backgrounds. And then finally, which relates to our last discussion too, when you are building your team, you are building it with the intention of making sure that you bring your product to market or your service to market. And so, are the gaps or are the areas that need to be fulfilled, those critical function areas, are we making sure that we are covering those and have bodies that are there who are going to be able to build out these important things? Or are we just bringing in people because we know them? And I see a comment from Tim. If founders are compensated with equity, do they have day jobs? Back to how are they paying their rent or mortgage? So it depends. And I think it's an interesting question, Tim, because I have heard some investors who believe if you are devoted and ready to build this company, then this should be what you eat, sleep, and drink. And so getting this product to market becomes really important. And so the way that people pay their rent is they either are bootstrapping in the early days of their business to make sure that they are able to get the business up and running. They are raising money either through grants. So we have an SBIR program that we have here within the Brink where you can start to get some early money, or they're raising money. And so the conversation that we just had around how much runway do you have, that's how much money do you have to be able to pay your staff so that they stay motivated to stay a part of the team. And so some of the ways that we do motivate people is by offering them equity in the early days. But it is very much a good question about, are people fully committed and on board, or are they doing something else? And I think that would be another consideration about, are you a team or not? Okay. Benton says co-founders can join teams at different levels and stages, but the minute you take investment, the founder needs to be all in. Yeah. Yeah. Thank you, Srivanas. Maybe when we get to Q&A, I saw Jonathan, who was here, who runs our SBIR. Maybe he could make a comment about that. And about whether SBIR is on hold. All right. So what do you think, before I show you the decision, do you think this team is going to get funded? Yes or no, and why? Do we think this team is getting funded? Melissa says very quickly, no. What do others think? They are not united in purpose. Yeah. Okay. What do others think? Are this team getting funded? And if not, why? And if so, why? Yes, it's AI. Uh, I love that, Byron. AI does seem to be the hot thing, right? Maybe the AI is real and can run a solopreneur. Maya definitely is a solo person. All right, so let's look and see what the investor says. So the investor says, look, I like the product, but this team isn't built to execute under pressure. And so remember, this is a presentation about team, and the investor is not just looking at the idea or the product. What they're really looking for are you a team that's going to be able to bring this over the finish line? And when things get hard, are you going to be able to do it? So the part of the decision is you don't have the agility to stay focused when new directions emerge. We already saw Liam and Maya debating whether or not they should go in that direction. And then we don't have perspective and diversity of thinking. And I built this into this decision on purpose because I see a lot of founders who believe that they got to take the helm, and because they are the founder that they have to make all of the decisions. And so I want you all to get into your mind very early on that making all the decisions and calling all the shots is not a sign of strength or team unity. You really want to make sure that you are creating from the beginning a culture where you are bringing in different perspective. The other piece that this investor says is that we need a lot of resilience in a startup, and I need the confidence that you're going to be able to navigate that friction and be able to come back together quickly. So this goes back to what Melissa said. This team was not united, and they need to be able to move forward together. The other part of this is what's the matter with this team? Think back to, let me just go back a couple of slides. And let's look at this team and who they are. What's the problem with this team? Why might an investor not like them? Absolutely, from all from UCSD. What might that suggest? What might that suggest? And what else is wrong with this team? Same ecosystem, yes. Trident myopia. Thank you, Benton, for that. Yes, I am in my own, I think it's Triton, but yes, Triton myopia, blind spots, absolutely. Yes, Byron, I love what you said. These seem to be people who just seem to know each other. And yes, they may be drinking each other's Kool-Aid because they are all Tritons. And so if we go back to our investor, I don't see full coverage across critical function areas. So we just spent an hour talking about valuation and figuring out what your business is worth. If you don't have the skill set and the capabilities required for you to scale, that means you're not going to be able to scale, which means we need a range of different capabilities and backgrounds, not just one. So at this stage, this investor says, I'm not ready to fund you. And the dreaded, let's stay in touch. So none of us want to be that person. So let's talk about how we should be designing our team. And this is a moment where I want you all to think about whether you are early in your team journey or if you have been building your team. I want you to think about how have you been thinking about who is part of your team and what that anatomy is. And let's think about what some of the pros and cons, what some of the cons might be to this. So the first model that I'm bringing in around how we might think about talent and bringing talent in our team is what I call the cost model, sorry. And this might sound something like, who's willing to work for free or to work for cheap? And so some of the downfalls of that, so a benefit could be, yes, you preserve cash. The downfall might be it weakens accountability because people may just feel like they have to say yes to something. And then long term, are they going to be willing to stay with you is a big challenge. Okay. And then we have maybe, excuse me, maybe Benton and Stephen, you can help me monitor. It's hard for me to monitor both chat and run this. Then we have the reactive model. And this might sound something like, I need to pick people to join my team as the need arises or when something breaks. Or maybe I'm going to pitch and I realize that there's a big hole in my team and I got to be able to fill that. So I'm reacting to something. And so while this may feel practical and like it will be conserving cash as well, in the long run, it's going to create gaps in terms of how you might be building out your product or your business plan. You may start to have some redundancy in what people are doing. And more importantly, it may create unclear ownership among the team. The final place is strategic. And so I am choosing people based on what the business has to master at this stage. And so if I'm early in my journey, we may have to get really good and crafty around how we are building an MVP or an early prototype so that we can get it in the hands of customers and start to validate. But as I figure out that I have a product market fit, I now need to think about how am I going to reach more of those customers, which means maybe now I'm ready where I need some marketing capability. So what I like about the strategic focus is it is designed with intention and purpose. And so your team is not something that happens haphazardly. It is focused around the stage that you are at, and it signals to investors that you are ready. And so I want you all to think about these three areas, the cost, I'm sorry, I can't show all of them at the same time, the cost, the reactive, and the strategic model. And I want you to think about where you are today. And I don't want to disclose where you are, but I do want you to think about if you are in the cost bucket where you feel like I just got to get anybody to have a warm body here, or you are in the reactive where you are waiting for something to happen. I want you to think about what would it take and what would you have to do in order for you to start getting to more of this strategic model. All right, so let's talk about the anatomy of how you should be thinking about a slide that's going to signal to investors that you are a team that's ready and investable. So the first thing that we could do is let's think about diversifying, as all of you have already mentioned, who our leadership team is. So Maya is our science person, and now you will see, by the way, she's not a single founder. We now have 3 co-founders who are here. And not only does Maya have AI and her virology background, she's had an exit, which would signal to an investor that this is a CEO who has had experience with closing deals and getting their product to the finish line where someone is willing to pay for it. Liam, who is our product guy, is also experienced in AI and has led product development at another corporation, which would signal he's seen some things that will be helpful as this team begins to scale. And Pat Money has an MBA, which will be helpful in us as we think about what kind of operations are going to be needed as we try to build out this product and get it manufactured and figure out how we get it and distribute it into the hands of customers. And Pat also brings growth mindset and strategy in the startup environment. But we've also now added some other bench strength to help us. And so advisors are amazing to put on your slide to fill in some of those gaps in knowledge and strategy and expertise. So we have Jane Smart, who has 20 years in business model, strategy and tech, biotech, CPG. So this person is bringing a ton of corporate enterprise-wide experience to us. And then we have John Operate, who is a past CEO in a fast-moving product space who can help us build some scalable tech solutions. And so as you are all thinking about your own teams and thinking about what it takes for you to get to market, think about those advisors who are who are able to kind of come in and be able to help you build and at least start to look like you are that you understand where those gaps are and you're starting to fill it. Are these advisors like our board of directors or Brink advisors? So it could be either, Melissa. And so once we start to have a board of directors, those are people who start to have fiduciary responsibility for our organization. Advisors, on the other hand, are people who come in and step in and advise us on our company, but don't necessarily have a formal board role. So yeah, I would say advisors, your Brink advisors, mentors that you are finding in the marketplace are all great people for you to think about including on a slide like this. It's adding to the expertise and adding credibility to your team. Good question. Okay. All right. So, last part that I want to focus on, I think I have a couple more slides here, is how do we start to motivate our team? And so, Tim spoke about how are people paying rent and how are they eating? And so one of the ways that we demonstrate long-term commitment and try to get our team behind our vision is we can use equity to be able to do that. And we can split that equity in the beginning. And so this is one of the reasons, one of many reasons why we like to be a C Corp, but in a C Corp, it allows you to have equity and stock options that you are able to give. And so when you're thinking about splitting equity among your founders, you want to think about, what's the work that people are doing? How is that work contributing to where we need to be? What is the comparable skill set that they are bringing? And back to Tim's point, how much time are these people going to be spending in the company? A couple other things that I think you want to consider. I've seen a lot of founders who give equity in the beginning, only to find, 6 months later that it's the wrong hire. And so they may be hired based on the reactive model or the cost model, and they found that the people don't have the staying power or are not interested in being in their company. And so you want to be thoughtful and careful about how you are giving equity out in your company. So there's a couple of things that I suggest you do. The first thing is absolutely having a vesting period over 4 to 5 years, where some part of that will vest year 1, year 2, year 3, year 4, and you can certainly make it where the highest vesting starts to happen in some of those later years to make sure that people are willing to stick it out with you. How much are these people involved in decision making with you? And then you also want to think about, so in the SAFE conversation, we talked about the pre and post and how you were going to be diluted as a founder. I'm sure by now all of you know that you want to maintain 51% of your company, or you can get voted off the island. So you want to think about all of that future dilution that's going to be coming too, and think about what those splits need to look like. And so this is a chart on the right from Carta. So now you've heard Carta 3 times in this presentation, or both presentations today. That gives you a rough estimate of how you might start to think about splitting equity among 2, 3, 4, or 5 founders. I don't know that I've ever seen more than 3 or 4 founders. But this can give us an idea. All right, let me look at some questions. So Melissa says, I have agreements that are not yet legal. Investors understand the remuneration will come in time with equity. This is less common in the spaces I work within. At what point would it be a good idea for legal contracts? So Melissa, are you, and you, please come off mute and let's chat about this a little bit. Are you saying that you have offered equity to employees, but you don't have that written in a contract form?
You're muted, Melissa.
Now, can you hear me?
Yes.
No, I can't hear you because I'm muted. I'm on two devices because I'm having a hard time hearing on one. Sorry.
I can hear you. We can hear you.
Okay, great. So it's in trying to build my team. I don't really usually have a problem finding someone who believes in what I do. I have 2 other problems. One is like the person that's saying what pays the bills. So I find people who are a good fit. They can't work for they can't work for future equity, right? And then there are other people that come on board and they're like, okay, I can handle this for future equity with, if I have this much every month, then the rest of it could be in some sort of stock options or future equity. So at what point does that kind of and so far, just to say, so far I've done the cliff of 1 year, and so far no one's made it, either
Yeah.
because we're not a good fit, or because of a death, or because somebody got a job offer elsewhere. So, but in May I'm coming up on my first person who will be a year. So then I feel like like Benton said, it seems like I should have something in place. So
Yes.
yeah.
I don't know if the legal folks, if any of them are still on. I would imagine it. I don't know. Kevin, are you still on, or Kit?
I think they're not, but that's a very good problem to take to office hours and
Yeah.
ask for a very standard agreement and get that in writing. And you're talking about cliffs. This is really important. Maisha, you wanna walk them through what the cliff is and what standards are?
Yeah,
And
so I don't like I actually have been asking people to think about, so that's the first the oh, sorry, Melissa. Yes, the cliff is at the point at which the stock starts to vest for people. And I have seen many examples, like Melissa has mentioned, of people coming in and getting equity. And if there isn't something in writing about you have to stay for this set period of time, they leave, and now they're leaving with equity in your company. And so, which may be fine, right? If you're a company and you aren't worth anything yet. But let's say you give someone, I don't know, 10% equity in your company. And in 5 years, 10 years, you are now $1 billion company, and they left after 4 months in the early stages. You're going to be pretty pissed off that they haven't actually contributed to the company at all. And so you want to make sure that you have some pretty I like a few years actually. I want people to stay. So you want to have in writing that you don't get the stock until you meet these different milestones, and timing can be a part of it. And Melissa, absolutely, you need to get that in writing. We are a very litigious society in the US, and oral agreements can get you sued.
Yeah, that's a couple $100 problem and $1 million potential problem.
Yeah.
So a few hundred dollars and a quick phone call and a form is an easy solution there. And then on cliffs, we always recommend you don't give anything vested right away. You have to earn it over at least a year for the first. But most equity options I see are over a 4 year
Yeah.
period, sometimes more, sometimes less, but whatever the amount is, in Maisha's example of 10%, you get 2.5% after 12 months, and then
Yeah.
another 2.5%. So
And
because
I've even seen it, Benton, where it's less, right? And you kind of
oh
tier it
sure,
up, right?
yeah, yeah.
That's almost where I would go, or the mile where it's, and maybe it can be milestone based too.
so
Yeah, and each position is different, and there are industry standards for each position, and what normal vesting is. And keep in mind that startup is a rough grind, but a lot of
Yes,
people can put up with it for a year or something, and they will just to get their options, but then they're gone. So as Mike just says, you tier it up. Maybe you only get 5% of your options after year one, and then 15% the next year, and then after 3 years you get 50% of them, so that they're really in and on your team and rowing in the same direction with you.
that's right. They're committed. There's a question about stock options. So stock options are different, right? So when you become a publicly I don't know if that's true. Well, if you let me think about it through the lens of a publicly traded company. You have options that can be qualified, or they can be RSUs that you can give to your employees. And stock options are given at a particular price based on where the market is at that particular moment. And then when the market moves up or down, when people are ready to exercise, that's the price at which they are able to get it. I think when we're talking about the startup world, we're talking about equity. And so if we go back to the conversation that we just had with the legal team, equity means I'm giving you some amount of shares of the company. And when we go to a seed round or a Series A, and that stock starts to become worth something, you're going to be diluted a bit, but they're also going to be going up in value for you. So we typically are giving equity in the startup phase. Oh, Melissa, go for it. And then Babak said for solo founders is vesting required. So when you're a solo founder and you start your C Corp, you're going to probably be the only person that gets the stock assigned to you. And so you will have 100% of it. And you will then determine how you are giving that out to other people.
Wait. Sorry, I'm not handling two devices very well. So stocks and equity, very different, right? So as I'm bringing people on board, I have a new guy with me, Rupert Dubler, who's here in this particular session with me. I wish he could come every time, but he can only come on Zoom because he's in Washington, D.C. So I know him from a long time ago, and he just transitioned from another company. So I don't mind being fully transparent. I want to learn. He wants to learn. But my question then is, at what point is as a potentially key lead employee, because he came on yesterday, as a potentially lead key employee at this point, he's not an executive, but I don't have much to offer him. So what can I offer him?
So,
Yeah, so
go ahead.
yeah, that's where stock options come into play. That's sometimes the only compensation you have in a startup. So, but you need to have it locked down in documents, and there are form documents. So it's not complicated, but
But not oral.
don't promise anything that you're not going to back up in writing right away. So yeah, I would take that to office hours. That's a few checklists that startup attorneys can run through quickly. Let's go back to Maisha's presentation.
Great.
And take that offline, Melissa. Thanks.
And so the last thing, there is a tool that I actually have on a slide. There's a tool called Gust, and they have an equity split calculator that runs you through a ton of scenarios and asks questions about like what the contribution of different folks will be on the team. So I would also suggest that as a good tool to help you think about like what would be a good amount. But this is definitely, and hello, Rupert, we saw you. This is definitely a scenario where I think you want to make sure that you have some thoughtful vesting period that you're putting in place, because like this is your company and your money. All right, so last slide, and then we can open it up. Is I think I can't impart enough that like we're all in this game of creating a company to solve a problem, and as you are solving that problem, your team is a reflection of your ability to solve that problem. And so investors are going to be looking for, are you all rowing in the same direction as someone put in earlier? Are you going to be able to take the body blows that come and be able to bounce back up? Do you have the skills that are needed to be able to think about the problem that you are solving from multiple angles? And do you have people who are going to be with you for the long haul, which is why that vesting period that we've talked about starts to become so important. And so the best tools at your disposal are going to be not taking anyone who says they're interested in your company, but thinking about how you, with intention, build a team that's going to challenge you, that's going to bring in diverse perspective, and that you're going to be able to create something really cool together. You need to have real clear roles and make sure that they align with your pain points that you're trying to solve, the problem you're trying to solve, and how you plan to win in the marketplace. When you cannot get all of those skills from team members, either because we don't have money to pay, or we just can't find the right people, leverage advisors either to come in and help you think about how you fill those gaps or to connect you. So the role of an advisor is not always just to give you advice, but sometimes they have connections that you can lean into that can help you to start thinking about how you plug up some of those gaps in your team. And then you can use equity to motivate people to build with you and also to demonstrate shared commitment and belief, but don't give up all the equity in the beginning. And then finally, here's some resources that I would recommend. So Benton kicked us off by saying the team was dysfunctional. And so um, my superpower is teams and team building, and so I can recognize dysfunction very, very quickly. So I do think, being able to root that out of your team, being able to handle conflict is really, really important. Crucial Conversations, The Fearless Organization, Brene Brown, anything is always good. And then some websites that start to help get you into the tactical pieces of splitting equity and thinking about, what am I contributing versus what maybe these other folks are contributing to my organization. And then last plug before I zip it. In April, I will be leading a 4 or 5 part series where we'll start to get into some of these things around how do you align a team and how do you build a culture by design, because the culture is going to happen whether you are doing it intentionally or not. So you might as well be very intentional in how you do it. All right. I will see if there's any questions.
Thanks, Maisha. Great stuff. What's
Yeah.
the date that your series starts? April? Have you nailed it down yet?
I think it's around the 10th of April, but don't hold me
Awesome.
to that. Yeah. Recommended number of advisors. Joseph, I have seen people have as many as like 4 or 5 on a slide, but you want your slide, like if you're thinking about, so remember, this is pitch prep. And so you want to make sure that whoever you are including on that slide for your pitch, that they're demonstrating that they're going to help you be able to execute on the plan that you're pitching. And so I don't think you need to put everyone on there. Think about the people who are going to be most integral to that. I don't know if you would add to that, Benton or Sylvia.
Yeah, I mean, obviously, if you're solo, you want to surround yourself with a lot of people, and having yourself and no co-founders and a couple of advisors is okay early on. And I have seen startups who are venture backed who have a board of advisors that is 20 plus people, but you wouldn't put those on a slide. You might have 2 or 3, that really fill the subject matter gaps you have in your founding team. Like ideally, you want to see 3 to 5 co-founding management team, and then if there are gaps, a couple of advisors or a well-known person who sits on the board, who's not full-time but has cachet and experience.
And if you don't have an exit or experience, I think, having someone on your board or an advisor who demonstrates that they bring that could be very, very helpful. Cool. All right.
Anyone else? So let's see.
My personal thing, I do like having 51, 49 decision making, voting, all of that stuff. So that's just my own personal preference. Yes. Keep the
Yeah,
51.
it really depends on the industry and the stage of the company. Because, if you're building a lifestyle business between two partners, that is always going to be 50-50 and you don't need outside investment. That can work, but it's a true partnership. Very few companies only have two shareholders. Almost always you're going to be raising funds and those numbers will change. So I wouldn't stress over it too much early on if you're planning to raise, because your investors will then break that 50-50 deadlock. All right. Well, Maisha, enlightening and really, really fun to see how dysfunctional teams can be made much better easily, right? So we see this stuff a lot. The Brink advisors, there are 20 of us. We've seen a lot of startups. We've seen a lot of decks. We're here for you. And some of the things that you're really stressing out early on, you should be stressing out, and that's rightly so, but they're not complicated problems for people who've been through it to solve. So ask us, right? And before you go, hey, I'm going to give you 15% of my company for creating my website that could have been done on Replit in 30 seconds.
That
We see it all the time. It
that's
happens.
actually a really good point. I've seen people who say that they want to give 3% of their company to someone who's building a really small piece of their product. Don't do it. Don't do it. Right? That
Yeah.
that that small piece of the puzzle may or may not work for your product long term, and you've now given up, equity in your company for the long haul. Um,
Yeah, there are like best practices and industry standards. So when you go to bring in, say, a named advisor or someone on your board, there's a range for what you should offer in options and what's normal. Someone coming in and asking, and anyone coming in that's not a co-founder asking for 10% or more should be an immediate red flag unless that's a major investor. So just keep that in mind. And just run it by us, run it by your Brink advisor. Sometimes it's as easy as a quick email to get that answer.
hey, Benton, there was a question from Joe who says, concerning the Brink, are you assigned one advisor or can you consult multiple advisors? You want to answer that one?
Um, we generally pair you with the advisor that's in your industry the most, but you're free to talk to others. You can't obviously have all 20 of us as full-time employees. It doesn't work that way. So we're limited in what we can offer, but we generally give you a primary. And then obviously if there's something that comes up, like, we have AI expertise, we have biotech expertise. And so we'll share client intel and give you the best answer. So you're not just limited to one. And if you don't like the one that you have, you can always change. It's completely free, completely confidential, and you decide how often you want to meet. We have a limit, but generally it's pretty reasonable. All
Awesome.
right.
Have a good
Well,
night.
thank you, Maisha. World class as always. So next week we're back in person. This was our one and only Zoom outing. So great turnout. Hope to see you next Thursday. It's going to be fantastic. Sylvia Ma, who's here with us, and Pankaj Kedia, two just powerhouses of deck design and AI, are going to be showing you how to build a deck with AI and troubleshooting. And then we have Professor Richard Clark, who's going to be talking about market opportunity, one of the other slides that I always gravitate to. So tune in. We'll see you for the pizza party next Thursday, back on campus at USD. For now, thanks. Appreciate you. Have a
Bye.
good evening. Cheers.
Have a good night.